But let's talk much more about the economic data now, because wholesale inflation did slow in February. It dropped 4.6% on an annual basis. That's a smaller increase, or it was up 4.6%, I should say, which is a slowing of the rate of increase here. To put it another way, the final demand number fell to 0.1% month over month, although if you back out certain items, you saw increases. Still less than expected. Is this the disinflation we have been waiting for? Let's dive into it with Moody's Analytics economist Matt Colyar. Matt, thanks so much for being here. So is this the disinflation we've been waiting for?
Well, one, thanks for having me. The CPI data yesterday is what we're typically going to focus on and put more weight on. And in that respect, the moderation is ongoing. But it doesn't have kind of the certain warm feeling that we had towards the end of 2022 when the declines were a little bit more predictable and a little bit more comforting. Now there's been this morning PPI data aside, kind of a sputtering in that trend in early 2023, a slower moderation than we'd like to see, but still heading in the right direction.
And as you said, the Fed going to be looking more at consumer price inflation, the CPI numbers and PPI. Services still hot. We got that number yesterday. And now Fed Chair Jay Powell has a huge decision on his hands. Do you think, wearing your Powell hat, if you could for a second here, is he going to err on the side of financial stability, looking at all the regional bank failures, maybe what's happening with Credit Suisse today? Or is he going to look at that hot inflation data and say, okay, we've got to keep up the hawkish rhetoric and also action here?
I would say leapfrogging maybe oversimplifies it, but the financial system stability has leapfrogged inflation over the past week. So I think if I were Fed Chair Powell, and what we're thinking is that does take precedent when the FOMC meets next week, and caution is the method. So we expect a pause. That doesn't mean that rate cuts or rate hikes are done. This doesn't necessarily would be deemed a pivot as much as it's because of all the turmoil in the banking sector over the past week. Caution would mean let's wait to see that the financial system is on solid ground and we can pick back up our familiar fight, implementing restrictive policy when the group meets again in May. So that's our current estimation. That's a lot can change in a week, as we've seen. We're a week from that announcement, but that's our expectation for the near term.
And I guess we haven't talked a lot about retail sales, but retail sales also came in weaker than estimated, right? With the drop of, or I guess in line with estimates, but still a drop of 0.4%. How do we sort of put all this together, right? What do you think is driving that retail sales number lower? Is it that consumers are finally feeling some of the pinch from higher prices? What's going on there?
As you mentioned, it was expected, and that wasn't an expectation that February was the month that the tightening of purse strings was actually going to occur, although there's underlying details that suggest that is what happened to a degree. But largely that negative number, and you're not looking for a negative number when it comes to consumer spending, but that number was expected because of a lot of idiosyncratic things that happened in January. So that 3% number was revised up to 3.2% growth from December to January. We're looking at month-to-month changes. So an acceleration from January was never in the cards. Happy to talk more about those effects, but largely January was unusually warm. You have the cost of living adjustment for Social Security. Those are one-time effects that would make an increase in February really unlikely. That's why you see Wall Street, our expectations all for a decline from January to February. Motor vehicle sales is something we watch. It's very volatile. If you remove that, it's more of a sidestep from January to February. Inflation is eroding purchasing power. You are seeing household balance sheets come under a little bit of pressure, and that will hurt consumer spending. But February certainly isn't sounding the alarm in coming from the retail sales side of things.
And Matt, just thinking about the incredible volatility we've had in terms of economic data and the people's expectations over the last week. You said just a few minutes ago, a lot can change in a week. Sometimes everything seemingly can. And it was only last Tuesday that expectations for more hawkishness at the Fed grew because Fed was sitting in front, Chair Powell was sitting in front of Congress. We had a peak in interest rates on Wednesday and then this regional banking crisis. How do you, as a Moody's analyst, how do you prepare for this? How do you model the economy in this? And is the uncertainty just making a lot of these prognostications that more, I guess, arbitrary maybe?
It's been a 3-year lab experiment in modeling and forecasting.
Yeah.
So we're kind of used to a wider confidence interval, if you will. We can look at fundamentals and base our decisions based off of what history has shown us. That's how we come to the conclusion that this Silicon Valley Bank episode would be, that failure would be relatively contained because we do have data on credit quality. And is this and the kind of things that give us a degree of confidence that it's not necessarily a pervasive fissure in the financial system. And we can think, okay, if that's not going to happen, from now until the Fed meets, that's probably too close to give the Fed any kind of confidence. But between now, if our expectations are correct, and there's not a wave of failing banks, particularly not large banks, given the capital requirements that they have and the stress testing they go through, you look out 6-7 more weeks from there, and you say when the Fed meets again, they'll have a little bit more confidence that the near-term rattling in the middle of March wasn't something that became kind of a secular crisis, and they can return to their fight against inflation. All right, that is our most plausible, our most likely scenario. But as you mentioned, there's certainly things that can happen that are very difficult to predict.
Yep, subject to change, and wish you all the best in your future lab experiments here. Really appreciate what you had to say here. Matt Colyar, Moody's Analytics economist.